Alrighty, welcome to week 3. I want to go ahead and apologize for being a little bit late with the holiday weekend. Things kind of got a little pushed back. All right, so diving into our housekeeping on module week 3. This week we are going to be reading chapters 4 and 6. And so you'll have the presentations and everything like last week for 4 and 6. And then in the activities and assessments, we will be another discussion board. So the discussion this week is on the 3 popular inventory methods. For each method, you have to select one industry that was going to use that method and describe why that industry would lead that method. And so we'll get into a little bit more of a discussion before we jump into the homework. You have the 4 and 6 Learn Smart assignments, and then our homework assignment number 3. Okay, so this week we have kind of 2 main focuses. Get back to our accounting cycle here. So the first part, we're going to be looking at preparing the financial statement. So last week we went through making journals, posting to the ledger, preparing the trial balance, making the adjustments. We're now at step 7 here, preparing the financial statements. We'll go through each one of those statements during the homework, figure out where from the adjusted trial balance we're finding the accounts, how each of the statements interact with each other. And then for pretty much the rest of accounting, we're going to spend the rest of the time going back to step 2 and focusing on analyzing the transactions and figuring out how to make journal entries for that. And so of the accounts that we've briefly touched over, and you'll see that they're giving you balances in, we're now going to go into each one of these accounts and kind of explain the nuances of inventory and fixed assets and each of these accounts in depth. And so the first round is at inventory. And the homework assignment doesn't have much on this, so I wanted to touch more on that. And so what we have is the FIFO and LIFO and the weighted average. So the question is always, with accounting, most people think that things are black and white. And so you look at a transaction, you figure out the journal, and you move on. But really, there's a lot of assumptions that have to be made, because in a perfect society, we would have all of the data necessary, and we can go through and do exactly the entry needed. But in reality, there's a cost benefit to receiving that data. Nowadays, that cost benefit is reduced with the internet and computers and processing and different automated transactions, different cycles. However, not all of it is, and we'll find out how data is a little bit hard to keep up with. And so with this example, the best example that I've heard of why you need FIFO and LIFO is, think of a hot dog stand. And so at the beginning of the morning, the person opens up all of the meat, puts it into a stand, and as each of the customer comes up, he grabs a hot dog, puts it in a bun, and gives it to them. So the question that we have as an accountant is, if when he opened up those packs of hot dogs, he spent a different amount on each package of hot dog, as he's dishing those hot dogs out, is he grabbing from the top of the bin where the most recent package is, or is he grabbing from the bottom of the bin where the oldest hot dog is? Now, hopefully he's mixing those up throughout. And so when we get to accounting, we really have no way of knowing exactly which hot dog he sold. And so we have to come up with an assumption, we have to come up with an estimate. And the different ways of doing that is FIFO is first in, first out, and LIFO is last in, first out. And what that means is, under FIFO method, the package that he opened first is the package that he's selling it to you. So if that package was $5, 10 hot dogs in there, every hot dog he hands out to the customer is going to cost 50 cents. We get $1 back. Okay. Under LIFO method, the very last package it goes in is the first one he's grabbing from. So as a customer, that's the one you want. You want that fresh hot dog that he just cooked right off the plate. Under the FIFO method, you're getting that older materials. And so the question is always, what impact does that have? If every single package of hot dog was purchased for the same price, you would have no impact. But that's never the case. So we have two different methods here, two different situations where either the price is going to increase or the price is going to decrease. And if the price increases, under each method, the cost is going to be higher or lower or versus the ending balance. So if we think back to that formula that we built in for the supplies, we're going to use that same formula for inventory. We have our beginning inventory plus our purchases is going to have to equal our cost of goods sold plus our ending inventory. Okay. And so what we're trying to figure out is when we have our purchases and we have our beginning inventory, how much of that ends up as cost of goods sold and how much it ends up as ending inventory. And so you want to have this on a flashcard and memorize these circumstances. If it's increasing, then your cost of goods sold is going to be higher under the LIFO and lower under the FIFO. And vice versa, if it's decreasing for the cost of goods sold part, it's going to be lower on the LIFO and higher on the FIFO. And why is that? It's because in an increasing price situation, the last item you purchased is going to be the most expensive. And so when you make your entry to push from inventory into cost of goods sold, that amount's going to be higher. And then your ending inventory will be lower, and then you switch that for the FIFO. Okay? So that's very important to remember as you go through and think of this. All right, with that in mind, let's jump into our homework. So like I said, we're going to be preparing financial statements. The first financial statement you'll always start with is the income statement. And the reason you'll always start with the income statement is because you have to figure out what happened this period. Then you're going to add that to what your balance was the end of last period, and then you'll get into your balance sheet. Okay. So we go from income statement to the statement of owner's equity, which means from the income statement, we take the net income, and we're going to move into the statement of owner's equity, where we add the net income to get to the ending capital, which is used on the balance sheet. And here, and we'll go in a little bit more detail, but that's how we're connecting these. So on the income statement, what's nice about the trial balance and why we spend so much time to make sure our adjusted trial balance is correct is because as their accounting is numbered, you'll always have it to where your assets are first, then we get into our liabilities, then our equity, and then our net income. Okay. And so when we made our flashcards and we defined assets, liabilities, equity, we're going to start a flashcard for income statement, each of these financial statements, and we're going to have to decide which accounts go on them. So on the net income statement, one key is that this is for the period ended. Okay, what that means is it's for a period of time. Okay, so it has to be either for a day, a month, a year, a quarter, whatever time period. Normally we use it for a year is what the SEC requires for most companies. If you're a large enough company, you end up having to do it on the quarter. Management results are going to be wanting it at least every month, and some results you want to actually look at maybe even more closely, especially inventory or cash, those items that have a higher degree of risk. So on the income statement, the income part, we're going to want all of our revenue and our expenses. And that's how we're going to list these out. So we first list all of our revenue. Like I said, everything's in order here. So we're starting right here, account 401, all the way down to the end of the revenue. We're going to create ourselves a subtotal there. And that's just the sum. Then we're going to list our expenses, and the same thing, all the way out in order, from there down to here. And that gets us to our net income is just total revenue minus expenses. Your credits here minus your debits. All right. And that gets you, so then you're going to use that net income and get into our statement of equity. So the very first line for the statement of equity, now this is also over a period of time because we're going from one day to the next. So from January to December, whichever one we're going with. At the beginning of the period, the statement, the equity by the owners was a certain balance. That balance is going to actually be here in your text. And the reason for that is because this balance that's listed here already includes an additional amount invested during that period. So we're going to want to break that out. So look at the text, and that gets you the beginning balance. And then it says we added an investment. The net income increases the owner's equity if it's positive. And then that's going to get a subtotal here, which is the beginning plus all of our additions. And then the owner took things out during that period, and you can see that in that separate account is the withdrawals. So again, everything's in order. We're looking at the equity. So our income statement had revenue and expenses. Our statement of equity will have the net income and have the beginning balance, any additions, any withdrawals, and that gets you to the ending. Then we're going to use that ending balance to go over to the balance sheet. So from this point, we're using everything that's left over. So our balance sheet has our assets, has our liabilities, and it has the ending equity balance. Not from here. If you grab this number, you won't total out. The equity comes from the roll forward ending equity. Because the reason why is because this trial balance already nets to zero. Our debits equals our credits. We're going to use these accounts right here to create our net income. We're going to use these accounts right here to create our equity. This is our assets and our liabilities. So if you grab only these items, you're missing out on all of these. So you're going to take that number from the statement of equity. All of the assets, all the liabilities, those come in exactly as they're stated on the trial balance. But when you get to your equity account, it comes from the statement of equity. Okay. Now we're finished with our period. Go back to our accounting cycle. When we're finished with our period, we now have to get ready for the next period, which means we have to close out all of our temporary accounts, because we said the income statement is for the period of time. Now that period is over, we need to get ready for the next period. So we're going to have closing entries. And what closing entries means is that, like I said, we're wanting our trial balance to still net debits and credits, but now all of these accounts have to go back to zero, so that way we can start over again. So all of these numbers need to get rolled into this number. We're going to do that with this three-step process. Step one is we're going to move all our revenue. So to get rid of, to zero out of credit, you debit it. So all of those accounts are going to get a debit. And to end step one, we're going to balance that entry by crediting the income summary. This number right here should match your total revenue. We're going to close revenue into the income summary. Then we're going to close out our expenses. Our expenses are debits. To clear debits, we need to do a credit. So we're going to credit all of our expenses. We need this entry to balance. We're going to balance that entry to the income summary. Again, this number should match your subtotal for expenses. Again, debits have to equal credits. Then we now have a balance in this income summary account, which is a temporary account as well. So we had a credit of this amount, we had a debit of this amount. So to zero that out, we need to debit it for the difference. That difference happens to be our net income. And then we're going to close that out into the capital account. Then we're going to zero out the withdrawal account. The withdrawal account's a debit. So we're going to credit it. And then now, we did this right. We had our beginning balance, 126. We're going to add the 25. The 6 is already there. And so the withdrawals is now zeroed out. So our ending balance, 146, should match what is on the trial balance of 146. And at the end of these entries, if you take that 132 plus 25 minus 10, you'll get to that same number. Make sure our ending balance is right. Now we're going to start doing analytics on those financial statements. So the reason that we present these financial statements and we put them out to our investors are going to dig through them, pick out the numbers that they need in order for them to feel comfortable based off of their risk portfolio. And so we're going to look at a few different ratios. Each ratio that's in the book, put it on a flashcard, figure out the formula, learn to plug and chug. So the first one we have here is the return on assets. So return on assets is the fact that each company is an investment. So even your mom and pop startup, you're having to get inventory, you're having to do you can't create something out of nothing. So there has to be some asset involved in this, and the question is, is it worth the investment of these assets into this company? And the question is, what return are we getting on those assets? So the return the company is making is going to be that net income, because remember, that's the amount that gets added to the capital. And then we're just going to divide that by the average total assets. So the key here to note is the average here, is because we need to match up a period of time account to an asset, which is a ending balance account. So the amount of assets you used isn't based off of the beginning of the period or the end of the period, but throughout the period, this is how much assets you had devoted to this company. This is the return. So again, just average, you add beginning and ending, divide by 2. Okay. Debt ratio, the question that most banks and investors have is, in the event of default, how much is there to pay the banks who have the first right of any liquidity versus the remaining amount that's at risk from the investors, okay? And the reason that's risky is because if the margin is low, then the bank has a higher risk of actually recovering the full value. Remember, the banks don't want any risk involved. They're lending you, well, except for normal, but they're lending you the amount with the expectation of a certain return. The investors are the ones that have a little bit more risk in that they don't have a set return. They're hoping they do better than the market. So with that in mind, we want to create that percentage to make sure that it should be, in each industry, the thing with ratios is these are all going to be numbers. The numbers aren't going to tell you anything unless you compare it to other companies or compare it to other periods. And we're going to want to see a trend that's leaning towards a particular answer. So here the debt ratio is just going to be your debt, which is total liabilities, divided by total assets. And remember, total assets equals total liabilities plus total equity. So it makes sense that the debt ratio is what percentage of your assets is tied to your liabilities first. Okay. Profit margin, again, you can't turn something into nothing. So the question is, how much did you spend on turning that something out of that? And we want to make sure that we're making more than we're spending, right? Because the reason there has to be some profit here. So the way that we determine what profit is how much was our net, how much did we earn, versus how much we took in. Okay, so that's how we look at total revenues, is the total amount, and what percentage of that did we get to bring to our investors? What profit did we bring? All right, so current ratio is the fact that we know that there's going to be an investment in these companies. They're going to need capital to continue to grow, but at the same time, your vendors aren't there for an investment. They're there to make sure that they get paid and paid timely. And so any of the short-term debt, we want to make sure that the company is in a cash position to be able to pay that. And so what we're doing is the current ratios, we're just looking at current. And so again, the definition of current is within that one period. So by the next time that we issue that annual statement, so current is typically 12 months. And so we're looking at what's going to, assets is going to be converted into cash over the next 12 months. Compare that to how much debt is going to be required to be paid off within 12 months. And ideally, we have more assets than liabilities. Again, it compares to different industries. So there's a lot of industries that are more heavy one way or the other. Okay. Big question one, but I think the other ones go a little bit faster, but we want to make sure that we're talking in very important. So this is just another representation of which accounts are used for which statement. So we have the adjusted trial balance, or the question is which ones are on the income statement and which ones are on the balance sheet and or statement of equity. And so as we go through this, like I said, all of the assets are on the balance sheet. All of the liabilities are on the balance sheet. All of the equity is going to be on the statement of equity. And then the revenue and expenses are in the income statement. And then the way that we net those out, so they just want a subtotal here. And then we have a debit sitting here and a credit sitting here. The way we balance this is by the net income amount. And so you see that is now balanced. If we debit the income summary, then we credit the capital, which is the statement of equity here, and that balances the new balance sheet. Okay. So again, just trying to figure out which account sits in which statement. All right, so we do talk about the inventory a little bit here, but the question at this point is just what is included inventory? And it might seem like a simple question. Inventory is whatever you pay for it. But so you're at the store, you pay $5 for the package of hot dog. That's going to be $5 worth of inventory. But then you think about it, and when the cashier rang it up, there was also a 7.5% tax rate. So the question is that added? Then I had to pay the delivery all the way to my store. So that was an additional $5 for the drive. Is that included? Then the hot dogs were special order and they had to be heated up a certain way. Does that include? And then I spent different things. So when we answer that question, the the line in the sand that we draw is everything that's required to get the inventory to your store and ready to be sold will be an inventory, which is included in the cost that we were talking about. Anything else is going to have to be expensed as incurred. Okay, so anything else we call SG&A, selling, general, and administrative. So selling is your advertising, anything that's relating to those sales, that's that period, because the advertisement, those sales, hopefully one sale leads to more sales, but at the end of the day, that's not something that is worth to the investors, so we add it into inventory. The only thing is what the cost of the inventory plus anything that gets it to your store, taxes and everything, and ready to go. Okay. Okay, so here we're just kind of build up 2 units available for sale. So that first half of the equation, beginning inventory plus your purchases equals your goods available for sale. So they tell you you started with 15 and $43 each. Every single time you added 15 units each week, and the price kept going up to those prices. So for here, it's just straight multiplication, this many units at this cost per unit. There's your goods. And then you sum that up, and you sum that up. So now you know you have 75 units available for a total cost of $3,495. And then we're going to go into LIFO, FIFO, or weighted average. So again, LIFO will start pulling from this bucket first and working our way up. FIFO will start with this bucket and start working our way down. So we're back to just closing entries. So again, step 1 is closing out your revenue. So our revenue has a normal balance of a credit. To close it out, we need to debit it. We're going to balance the entry in the credit account through income summary. Closing our expenses. Again, our expenses are normally a debit. Zero them out, we credit. Balance the entry by debiting income summary. So what that does is our revenue creates a credit, expenses create a debit. The ending balance is a credit in income summary. Step 3 is closing that out. So we have a credit here. We want to debit it. The offset goes to our capital. It's now closed into capital. We also need to close the withdrawals that we tracked for that period. So we now have the beginning capital plus our net income, less our withdrawals, ending balance. Okay. So just definitions here. So temporary accounts, the definition of a temporary account is something we're only using to accumulate the data for one period. Each period we need to close those out. So that way we can go into and see just the transactions for that period. And again, the definition of temporary is any income statement account, any withdrawal account, and the income summary account itself. Those are the listing of temporary accounts. They have to start the period with a 0 balance, all because they're temporary, revenue, expenses, withdrawals. And the income summary is a temporary account that contains credit. Okay, so again, that's just matching up those definitions. And then they want you just to build the statement of equity. So you always start with the beginning, then you add your income, subtract your withdrawals, gets you to ending. Okay, here we're talking about FOB. So remember on inventory, we just stated that we're able to add to inventory costs everything, the cost of the inventory and everything that requires it to our store ready for sale. And the question is, en route, if something were to happen during a shipment, so UPS lost my shipment, whose inventory is it? Because remember, this is a business-to-business transaction. Me as the buyer needs to know, is that in inventory already, or is that purchase not made yet? And then as the seller, we're trying to match up revenue to expenses. Did they make that sale or not? And so we have to come to an agreement on, during transit, who's responsible for that inventory. And what we call freight on board, so who's responsible for it while it's on board? It's just the shipping terminology, FOB. And behind that is going to be either destination or origin, FOB origin, sorry, I forgot the. So, and again, you have to look at it. So FOB destination means we're not going to switch over until we get to our destination. So it's still the seller's ownership. FOB origin means as soon as it's loaded onto the truck, it's up to you. So on the UPS losing the package, FOB destination, package is coming to me, UPS lost it, you never gave it to me, it's not my inventory, that's the seller's responsibility. FOB origin, the second it hit the UPS truck, it became my responsibility, and I'm the one that's responsible for any of the insurance. So again, the question is just who pays for the insurance if it's that valuable, who maintains ownership up until the point of delivery. Okay, and so here, the company, so who's going to include the 12,500 of merchandise as part of the year-end inventory? And so again, it's not FOB destination, so it's not going to switch to Harlow until it reaches that point. So it's still in transit, that's Harris. And Harris, this time we ship goods. So here the definition of the cosigner. The cosigner is the one who's shipping the goods. Okay, so I cosign these to you. And Harlow is a cosignee. They're the beneficiary of the cosignature. So again, just the terminology here. So cosigning, I'm shipping you these goods. Harlow's going to hold on to these goods in the attempt to sell them. And if they don't sell them, these still belong to Harris. We're not selling these, Harris is not selling these to Harlow until the sale is made. If you studied Walmart's inventory setup, this is how they have it set up. The goods on display in any Walmart center don't actually belong to Walmart. They belong to the supplier until the point it actually scans. And at that moment, Walmart buys it from the supplier. Then Walmart turns around and sold it to you. You walk out the door. So that's the co-signator relationship. And in a co-signator relationship, as I said, Harris doesn't make the sale to Harlow, and therefore any unsold goods need to be in Harris's store. All right, so again, we have an adjusted trial balance. We want to make an income statement. We're going to put up our revenue first, and our expenses, sum that up, and income. And we can look at what's a revenue, what's an expense. There's our assets, there's our liabilities, there's our equity. And so we're looking at revenue minus expenses. And then from there, the statement of equity. So we have to check to make sure that we didn't have any additions this period. We say the balance was that of 2016. Put that down. We'll take our net income, move that from here to there. less the withdrawals. There we go. Okay. And again, the question is, what is included in inventory? So obviously the price of the inventory, FOB shipping point. So the moment he shipped it, it went away. So the cost of the goods is on the receiver's plate because at the moment it shipped, it went away. So we're going to add that in. We insured it. And before we were able to make the sale, we had to clean and refurbish it. So again, anything that's required to make this inventory ready for sale, we're going to add to those costs. Okay. And that brings us to the end. I did want to go into the example of showing how that FIFO LIFO works again. So most of the time we'll go ahead and assume that we're in a inflationary period. There's been a few moments in history we've actually been in a deflationary. Certain goods do become cheaper over time. So again, it just depends on the industry. And that's your homework tonight, is to figure out how FIFO, LIFO, and weighted average are specific to different types of inventory. And the question is going to be based off of how volatile the price is, how much quantity are we talking about here. So if you look at a museum or an artwork, each art is very specifically identifiable for a very material price. So there's no way we're going to group Monet and Picasso together and create an average price of those two together. So those will use specific methods. But that's one extreme. Like I said, the other extreme is the hot dog stand, any of those items. Which one would you think makes more sense? And with that, so as you can see with FIFO, each time you end up with a lower cost of goods sold than LIFO, but that means you have a higher inventory. And again, the question that you'll end up being asked is, which one of these is more relevant? And think of your tech industries where old technology tends to not be the same price as it once used to be. So CDs these days are a dime a dozen. Back when I was in school, we still paid $20 for the latest album. So any CDs that are still in inventory are going to be priced at that higher cost in our inventory, but is that still realizable? So the LIFO method connects your ending inventory closer to the current price, but because of that, that higher price is sitting in your P&L. Also think of the tax implication. When you think net income is what we're taxed off of, net income is revenue minus expenses. We want a higher expense to create a lower net income. Lower net income, lower taxes. Seeing as this is a timing difference, if you had zero inventory, all of it would be an expense. This is just a timing difference. We want to pay the government as late as possible. We're going to opt out for that LIFO. Okay, so I'll let y'all have that. And with that, have a good night, and I'll see y'all next week.